In 2025, artificial intelligence, it just stopped being this sci-fi buzzword and became the single biggest financial story on the entire planet. We're talking about a tidal wave of cash, tech, and just pure ambition that completely reshaped markets. So that's what we're going to unpack today. We'll follow the money, see who really won, who lost, and try to figure out what it all means for what's coming next. All right, let's get into it.
So this is really the question hanging over everything, isn't it? The numbers you're about to see are honestly mind-bending, but the uncertainty is just as huge. After a year of absolutely explosive growth that was followed by these sharp, sudden drops, literally every investor on Earth is asking, did we just watch the birth of a revolution, or were we just front row for the biggest bubble in history about to top? Okay, so to even begin to get a handle on the story of AI in 2025, you have to start with the sheer scale of the investment. And I'm not talking about a little stream of cash. This was a tsunami, a flood of capital so immense it's kind of hard to wrap your head around. These next few slides should help put it all into perspective.
Let's just start with this number, $423 billion. That's the combined capital expenditure, the committed budget, that just the big tech giants like Microsoft, Google, Amazon, and Meta plan to pour into AI infrastructure this year. We're not talking about maybe money. This is cold, hard cash being spent to build the physical backbone of our AI future.
And where does all that super expensive hardware actually go? It lives inside these massive data centers. So on top of all that big tech spending, another $61 billion, a brand new record, flowed directly into data center deals. This kicked off a global construction frenzy, basically building these giant, power-hungry, air-conditioned homes for all this AI. It's a critical and honestly an often invisible piece of this whole puzzle.
Of course, the giants weren't the only ones writing checks. For the startups trying to be the next big thing, the money flowed even faster. Private AI venture funding was on track to literally double what it was in 2024. But here's the really interesting part. The actual number of deals went down. So investors weren't just sprinkling cash everywhere. They were funneling enormous amounts of money into fewer, bigger bets on the companies they thought were the clear winners. So with nearly $500 billion just flooding the system, where did all that money actually end up going? Well, to answer that, we can look at a classic investment analogy that in 2025 proved to be more true than ever before.
This was the mantra of the year, for sure. While the whole world was obsessed with the promise of these next-gen AI models, the gold, the truly reliable money was being made by the companies selling the essential tools needed to find it. The picks, the pans, and the modern-day shovels.
And what are these modern shovels exactly? Well, they're the core components of AI infrastructure. We're talking about the physical hardware, the specialized buildings, the raw electricity, everything that's required to make these incredibly complex AI models actually work. It's the unglamorous but absolutely essential foundation for this entire boom. And this breaks it down perfectly. You've got the GPUs and the custom chips. Those are the brains of the operation. The high-performance servers that hold them, that's the body. Now, all that thinking generates a ton of heat, so you need powerful liquid cooling systems, basically industrial-scale AC. All of this eats up staggering amounts of electricity, which is the fuel. And it all has to be tied together with high-speed networking, which acts like the nervous system of the whole data center.
Okay, so that's the theory of selling shovels. Now let's see how this actually played out in the real world, with the wild stories of two very different companies, both right at the heart of the 2025 AI boom. So on one side, you have CoreWeave, a super high-flying, pure-play AI company that gives people access to the most sought-after GPUs. Think of them as selling the fanciest, most high-tech shovels you can buy. And then on the other side, you have Vertiv. They make a critical, but way less glamorous component, the liquid cooling systems that keep those expensive GPUs from literally melting. Man, CoreWeave's year was just a perfect picture of the market's mania and its anxiety. It goes public in March at $40 a share. Then, fueled by pure hype, it skyrockets over 360% to a peak near $187. But then, reality hits. A delay at just one data center partner forces them to lower their revenue guidance, and boom, the stock gets hammered, dropping over 63% from its high, an absolute roller coaster. So what happened? What caused that crazy reversal? Well, the whole market just started getting indigestion from those huge spending numbers. And for CoreWeave, investors started asking those tough,
boring financial questions about more competition, the company's pretty big debt load, and the very real chance their profit margins could get squeezed. The party was over, and the scrutiny began. So, in the meantime, what was going on with our other shovel seller, Vertiv? Well, this represents its incredible multi-year gains, a surge of over 1,000%. So while the high flyer was on a roller coaster, the boring but essential parts maker was on an absolute rocket ship. And the reason for this huge difference is really the key to the whole story. See, it didn't matter which GPU provider won the big contract, or which AI model was being trained, or which cloud company was building the data center. They all needed one thing: cooling. The demand for these essential, non-negotiable parts was just structural and relentless. It rewarded the steady, critical players over the more speculative, high-hype names.
So why does any of this boom in data centers and infrastructure and crazy stock prices, actually matter to you if you're not an investor? Well, because in 2025, AI finally stopped being something that just lives in some far-off cloud. It started showing up in our daily lives in very, very real ways. Take a trip to Walmart, for instance. This year, the retail giant rolled out AI tools that can create the perfect shopping list for you, use your phone to guide you to the exact spot on the shelf for that one item you can never find, and then give you a delivery estimate that's accurate down to the minute. All that massive infrastructure investment is translating directly into making your life a little bit easier. But it wasn't just about convenience. The boom also created brand new ways for regular people to make a living. It wasn't just for giant corporations anymore. A whole new wave of entrepreneurs and creators started building and selling their own AI-powered digital products, creating a powerful new lane in the creator economy.
And look, these aren't just hypotheticals. This is real, verified data. One creator earned over $420,000 in a single year selling AI-generated content calendars. Another started pulling in over $9,000 a month from AI-powered finance trackers. And a third made nearly $12,000 in their very first month just selling AI-generated templates. This was AI supercharging the side hustle in a huge way.
And all of this, the huge investment, the wild stock market, the real-world adoption, it brings us right back to that massive question everyone is wrestling with as we head into 2026.
Right. After a year like this one, what's next? Does the market need to take a breather, digest all these massive investments, maybe leading to a painful correction? Or was 2025 just the opening act for a long-term tech revolution that's only going to speed up from here? There are really powerful arguments on both sides. The bulls, they'll point to that very real structural demand for infrastructure, the fact that big tech is speeding up, not slowing down its spending, and the record earnings from key suppliers. They see AI being adopted everywhere, and they say this is just getting started. But the bears, they'll point to the massive volatility that surged late in 2025. They'll argue that valuations are stretched to historic highs, that bubble fears are totally justified, and that the risk of companies just failing to deliver on these huge promises is still incredibly high.
So, the ultimate question as we look ahead, it isn't really about if AI is a big deal anymore. I think that debate is pretty much over. The $500 billion question for 2026 is way more subtle. We know the transformation is real, but did the market in all its excitement pay the full price for an entire decade of progress in just one single frantic year?
So, 2025. That was the year the world was completely gripped by a new kind of gold rush: artificial intelligence. I mean, all the headlines are focused on the big names, the big tech companies digging for digital gold. But the real, lasting fortunes, they were quietly being made somewhere else entirely. Today, we're going to break down the 2025 AI boom to answer one simple question: who really struck it rich? Let's dig in.
To really get the sheer scale of this, you have to start with this number: $423 billion. That's the amount of cash that companies confirmed they spent on AI infrastructure in 2025, in 1 year. This wasn't just a little investment. This was a full-on global construction frenzy, a tech arms race to build the very foundations of our AI future. It was gold fever.
I mean, that number just sets the stage perfectly, right? It's the price of admission to the whole AI boom. But it also raises the most important question of all. When that much money is flying around, where does it actually go? It doesn't just stop with the famous companies at the top. No way. It flows down through a whole ecosystem of suppliers and builders. So that's what we're going to do. We're going to follow the money.
To figure this out, we're going to use an analogy you've definitely heard before, but man, it has never been more true.
During a gold rush, it's almost always a better bet to be the one selling the picks and shovels than it is to be out there digging for gold. The prospectors, they take on all the risk, right? They're chasing a dream. But the folks selling the tools, they get paid no matter who finds gold. And in an AI gold rush, it's the exact same story.
Of course, everyone knows the Magnificent Seven, those giant tech companies spending billions on AI. They were all over the news, dominating the conversation, but this explainer, it isn't really about them. It's about the companies that made their whole gold rush possible. The ones selling the graphics cards, the servers, the cooling systems, the digital picks and shovels of our time.
And when you talk about selling those shovels, there is one undisputed king, Nvidia. Their GPUs are the single most critical piece of hardware for building AI. And you don't have to take my word for it. Their CEO, Jensen Huang, pretty much said it all in late 2025. Blackwell sales are off the charts, and cloud GPUs are sold out. That's not just confidence. That is a statement of total and complete market dominance.
And the numbers? Well, the numbers are just staggering. They back him up completely. Just look at their third quarter results for fiscal 2026, a record $57 billion in revenue, up 62% from the year before. But here's the real story. Look at that second line, data center revenue. $51.2 billion came directly from selling AI hardware. That's almost all of it. And that part of the business grew even faster. Nvidia wasn't just part of the AI boom. Their data center business was the boom.
But here's the thing. When you cram hundreds of thousands of the world's most powerful computer chips into data centers, you create a massive, massive problem. Heat. We're talking about a colossal physics problem. So if Nvidia was selling the super-powered engines of the gold rush, it created this urgent new market for a completely different kind of shovel. So the next question is, who got rich selling the ultimate air conditioner?
And that brings us to the next layer down, the boomtown builders. These are the companies making the physical stuff that houses all this AI. We're talking about the servers that hold the chips, the wild cooling systems that keep them from literally melting, and the power grids that feed their crazy appetite for electricity. This is the unglamorous but absolutely essential side of the business.
Okay, our first case study here is a company called Supermicro. They build the high-performance servers that are at the heart of every AI data center. Now you'd think, with demand for AI servers going through the absolute roof, they'd be printing money, right? But the story's a bit more complicated. In 2025, they actually faced huge margin pressure. That means even as they sold more and more servers, their profit on each one was actually shrinking. It's a critical lesson. Not all shovel sellers get rich equally.
Now look at this number. Over 1,000%. And no, that's not some flash-in-the-pan crypto-style gain. This is the multi-year stock gain for a company called Vertiv. And who are they? They're the ones who solved that massive heat problem we just talked about. They make the specialized liquid cooling systems. And this just brilliantly shows the difference between two very different kinds of suppliers. So you've got this perfect tale of two suppliers. On one side, you have Supermicro. They're in a high-volume, high-demand business, but it's also super competitive, and that just crushes your profits. On the other side, you have Vertiv. They're also selling a critical, high-demand product, but they do it in a specialized, defensible niche. So while Supermicro was getting squeezed, Vertiv's business was solid because their tech was uniquely essential. The takeaway? Sometimes the most profitable shovel isn't the most obvious one. It's the one that solves the single toughest problem.
Now, a boom this big doesn't just enrich the companies that are already around. It creates entirely new ones from scratch. All of a sudden, we saw the rise of these specialized AI clouds, companies that just bought tens of thousands of GPUs and rented that computing power out. They were a pure, concentrated bet on the AI boom going on forever. And that raises a fascinating question. What happens when that pure gold fever collides with market volatility? What does that boom and bust cycle really look like for them?
And that brings us to our most dramatic case study of 2025, the story of CoreWeave. This is a perfect, almost movie-like example of the incredible highs and the truly terrifying lows of a gold rush. It's a true cautionary tale about what happens the moment the fever finally breaks.
So what is CoreWeave? They're a specialized cloud provider. Unlike the big guys like Amazon or Google who do a bit of everything, CoreWeave did one thing and one thing only. They offered massive amounts of GPU power specifically for AI companies. They were so important that Nvidia itself backed them, which made them the ultimate pure-play bet on the infrastructure boom. If you truly believed in the AI gold rush, CoreWeave was your horse in the race.
And man, what an absolutely wild ride it was. Let's just walk through this timeline. CoreWeave goes public right here, March 27th, at $40 a share. The hype was just insane.
By the middle of the year, it peaked all the way up here, around $187. That is a staggering 367% gain in just a few months. But then, gravity kicked in. By December, the stock had corrected all the way back down to around $67. Now, that's still up from the IPO, sure, but it's also a painful, dizzying 63% drop from its peak.
This bar chart really puts that roller coaster into perspective. That IPO price of $40 looks so small next to that massive peak of $187, but then that same peak just towers over the year-end price of $67. It just shows how quickly a fortune could be made, and then just as quickly have a huge chunk of it erased. The entire journey from euphoria to fear happened in less than 9 months.
So why did the fever break? Well, it wasn't just one thing, it was a perfect storm. The market as a whole started to digest all that spending, and investors began asking tougher questions. CoreWeave itself had taken on a ton of debt to buy all those expensive GPUs. At the same time, competition started heating up, squeezing their profits. And then a very real-world problem hit. A delay at a data center pushed their expected revenue out into the next year. It was a chain reaction of big market concerns hitting very specific company problems.
All right, so we've seen the dominant king, we've seen a tale of 2 different suppliers, and we've seen the boom and bust cycle of a pure play. So what can we actually take away from all of this? Let's distill these stories into a kind of frontier guide, 4 practical lessons from the 2025 AI gold rush.
First, timing matters. The CoreWeave story proves that the biggest, most explosive gains often happen in that early, frantic phase. Second, look for real earnings, not just hype. That's the Supermicro versus Vertiv lesson. Huge demand doesn't always equal huge profits. You got to dig deeper. Third, diversify across the entire stack. That doesn't just mean buying different stocks, it means understanding how the pieces connect. A bet on GPUs is also a bet on needing more power and more cooling. And finally, number 4, you have to understand that volatility is just part of the game. The wild swings of CoreWeave aren't a bug, they're a feature of any gold rush.
So in the end, the AI boomtown of 2025 was absolutely real. The investment, the technology, it's all transformative. But what this look back shows is that, just like in every single gold rush throughout history, the most durable fortunes are often built not by the prospectors, but by the people who built the essential, unglamorous infrastructure that made the whole thing possible. And that leaves us with one last fascinating question. We've seen the blueprint for how the first AI boomtown was built, on a foundation of GPUs, servers, and cooling. But technology never ever stands still. So what will the next one look like? And maybe more importantly, what are going to be the essential picks and shovels of tomorrow?
So 2025, what a year. It was supposed to be the year AI changed everything. We heard all about it, right? How it would reshape whole industries, create trillions of dollars in value, and kick off this brand new era of innovation. But, as the dust starts to settle on what was a really wild year, a different question is starting to pop up. What if this whole gold rush is just a mirage? What if under this massive mountain of hype, there's just a whole lot of risk? I mean, to really get a feel for the scale of this boom, just look at this number, $57 billion. That's more than the entire annual GDP of a country like Croatia. And this isn't some country's output. That was Nvidia's revenue for a single quarter. It's just an absolutely staggering figure that shows this almost bottomless global hunger for the silicone brains that are powering this whole revolution. So where are all those chips going? Well, they're fueling this, a $423 billion spending spree by big tech, forecasted just for 2025. I mean, that's a number so huge, it's almost hard to wrap your head around it. We're talking about the biggest companies on the planet building these new digital empires, these massive data centers just rising out of the desert, all in this frantic, high-stakes race to own the future of AI.
Now this is where it gets really interesting, because this slide shows you who's really getting rich. It's a lesson straight out of the old California gold rush, The folks who made the most money weren't always the ones digging for gold. They were the ones selling the picks and shovels. Well, in the 2025 AI gold rush, companies like Vertiv are selling the digital shovels. This 1,000% gain, that's their reward for making the essential gear, like the liquid cooling systems, that stop these new superpowered data centers from literally melting down.
Okay, so with this much money flying around, with gains this astronomical, you have to stop and ask the big question. It is so easy to get swept up in all the excitement, but as anyone who's studied history knows, every single gold rush, without fail, eventually faces a moment of reckoning. And that's the question we have to ask ourselves right now. Are we watching true innovation, or are we living inside an AI bubble that's just about to pop? And here's where the story starts to get a little weird. This chart, it's really the first sign of trouble. You see, despite all the AI hype that's been driving the market all year, the tech sector was recently one of the worst performers. It's like the party's in full swing, the music's blasting, and then suddenly someone just yanks the plug. That disconnect, right there, that's the sound of investor anxiety starting to creep in. And that anxiety, it's not just a feeling, right? It's a reaction to what's happening on the ground. I mean, put yourself in an investor's shoes. You see companies taking on record-breaking amounts of debt to build these giant data centers. You see all the spending, but you're not quite seeing the profits to match it. You'd start to get nervous. And when enough powerful people get nervous all at the same time, you get a global sell-off, which is exactly what we saw back in November. All right, so let's zoom in a bit. Let's get out of that 30,000-foot view and see how this all plays out in the real world. To understand this volatility, we're going to look at one company that basically experienced the entire AI hype cycle, the dizzying highs and the crushing lows, all in 1 year. This is the story of CoreWeave. Just look at this ride. It is a total roller coaster. CoreWeave goes public in March at $40 a share. It gets caught in that AI updraft, and it just turns into a rocket ship, soaring to almost $187. That's a 367% gain in just a few months. Incredible. And then, just as fast, the engines cut out. The stock comes crashing back down to earth, falling all the way to $67, a brutal 63% drop from its peak. So what happened? What massive disaster caused this crash? A huge scandal? Corporate fraud? Nope. Get this. It was a simple delay. A delay at a single data center that just pushed some revenue from one quarter into the next. That's it. But in a market that's priced for absolute perfection, that tiny stumble highlighted what analysts call execution risk. And that's just a fancy way of asking, can you actually deliver on all your big promises? For CoreWeave, that tiny little delay was enough for the market to scream no. Okay, so CoreWeave's story is a really powerful cautionary tale. But here's the thing. It's not just the new kids on the block who are feeling the heat. If a small operational hiccup can torpedo a rising star, what happens when bigger, real-world problems start to hit the titans of the industry? Because even the biggest names in tech, they're starting to show some cracks. This past year, the famous Magnificent Seven, the stocks that were carrying the whole market, well, they kind of broke apart. It became a tale of two different markets. Over on one side, you've got your high flyers, your Nvidias and your Alphabets, just riding that AI wave to new heights. But on the other side, you have these wounded giants, companies like Apple and Amazon, who have been really struggling to keep up. It just proves that being a tech behemoth is no longer a guarantee you're going to win. And the reason for this big split, it's not some super complex algorithm or secret tech. It's old school geopolitics. I mean, imagine you're Apple. You build your iPhones in China. All of a sudden, the US government slaps heavy tariffs on goods from China. Your costs just explode, your profits shrink, and your stock takes a beating. It's a pretty brutal reminder that in this global economy, even the biggest, most powerful tech companies are really vulnerable to political shocks. And even among the winners, the warnings are getting a lot louder. An analyst over at the Motley Fool put it pretty bluntly when talking about another member of the Magnificent Seven, Tesla. His advice? Avoid it. He basically argues the stock is just way too expensive, that its valuation has gotten so far ahead of itself that the risk of a painful crash is now much bigger than the chance for more gains. So what have we learned from this whole wild ride? We've seen a newcomer get totally burned by hype, and we've seen a giant get slowed down by something like tariffs. It's time we piece this all together, look at the evidence, and really identify the crucial red flags that can help us all navigate what's looking like a pretty treacherous road ahead in 2026. So, how do you spot a company that's all sizzle and no steak? How do you separate the real innovators from the flashes in the pan? Well, it really comes down to looking for three critical red flags. First, you have to look past those shiny revenue numbers. Second, you got to ask the hard questions about all that spending. And third, and maybe this is the most important, you have to develop a healthy dose of skepticism for the hype cycle itself. Let's dig into that first red flag. Super Microcomputer is the perfect example here. They were selling a ton of the high-powered servers everyone needed for AI. Revenue was absolutely booming, but the stock struggled. So why? Because of intense competition, shrinking profit margins, and issues with their inventory. It's kind of like a restaurant that's packed every single night, but is still somehow losing money. Booming sales don't mean a thing if you can't actually turn them into profit. All right, on to red flag number 2. Remember that mind-bending $400 billion number we saw earlier? All that cash being poured into building data centers? Well, investors are starting to ask a very simple, very direct question. Where's the beef? They see the spending, they see the debt racking up, and now they want to see the return on that investment. If those earnings don't start showing up, and soon, confidence could absolutely shatter.
And finally, the most dangerous trap of all, the hype cycle. CoreWeave is just a textbook example of what happens when a story gets way, way ahead of the reality. The stock goes vertical, everyone piles in because of FOMO, and then gravity takes over. It's a tale as old as markets themselves, and it's a story that is absolutely guaranteed to play out again and again as this AI boom continues.
And that brings us to the ultimate question as we head into 2026. The AI revolution is absolutely real, and that spending is only going to get bigger. But not every company is going to survive the ride. Some will navigate these red flags and become the giants of tomorrow. Others are going to get swept away by the hype and become cautionary tales. The real question is, who will be the next Google and who will be the next Pets.com?
So 2025, what a year. It was like watching a modern-day gold rush unfold right before our eyes. But instead of people flocking to California with pickaxes, the treasure this time was artificial intelligence. And the race? Well, it was on to build the massive, massive infrastructure needed to power it all. Today, we're going to deconstruct that absolute frenzy.
Okay, let's dive right in. To really get what was going on, you first have to wrap your head around the sheer, mind-boggling scale of this investment wave. I mean, the numbers tell a story of ambition that's just off the charts. We've seen tech booms before, sure, but this was supercharged for the age of AI.
$423 billion. Just let that number sink in for a second. That's the estimated capital that big tech alone poured into building out their AI infrastructure in 2025. This wasn't just a casual investment. No, this was an all-out arms race to get as much computing power as humanly possible.
And if that wasn't enough, on top of that, another $61 billion flowed into data center deals. We are talking about a global construction frenzy, a mad dash to build the physical homes for all this new AI hardware, and to do it before the competition could even blink.
You know, this quote from Nvidia's CEO Jensen Huang just perfectly nails the mood of 2025. It wasn't just optimistic, it was almost frantic. This idea he talks about, the virtuous cycle, it's this crazy feedback loop where more computing power lets you build more powerful AI, which in turn demands even more computing power. And around we go.
But here's the thing about any gold rush, right? For every prospector who strikes it rich, there are countless others who end up with nothing but dust. The AI boom was absolutely no different. And to really see why, let's look at the incredible story of a company called CoreWeave. CoreWeave was basically the poster child for the entire boom. Their whole game was providing the raw computing power, we're talking GPU as a service, that every single AI company was desperately trying to get their hands on. And with heavy backing from Nvidia itself, I mean, they looked like a sure thing. So check out this timeline. It is a total roller coaster. The company IPOs at $40 a share and then just goes on an absolute tear, rocketing all the way up to about $187. But then reality hits. In November, word gets out about power-related delays at their data centers, and that just shook investor confidence to its core. The stock came crashing right back down to earth. So what's the big takeaway here? I mean, if you look at the numbers, yeah, investors who got in at the very beginning still ended the year with a pretty nice gain. But for anyone who jumped in near that peak, oof, the journey down was brutal, a 63% drop. It's just a powerful reminder of the insane risk that comes with chasing the hype. And you have to understand, this wasn't just a CoreWeave problem. Not at all. Their story was really just a symptom of a much larger trend, one that revealed this critical split between the companies actually digging for the gold and the companies who were selling them the tools to do the digging. On one side, you had what we're calling the gold miners, companies like CoreWeave and the server maker Supermicro. Now, even though the market was booming, they were getting absolutely squeezed. Intense competition, pressure on their profits, worries about high debt, they were on the front lines, and believe me, it was a tough place to be. And all that intense pressure on the frontline guys, well, it brings us to a classic investment strategy. It's as old as the gold rushes themselves. When everyone is frantically digging for gold, the really smart play is often to be the one selling the picks and shovels. The idea is actually pretty simple.
Instead of trying to bet on which single miner is going to find the biggest gold nugget, you invest in the foundational suppliers, the companies that sell the tools to all the miners. See, their success isn't tied to one company winning the race. It's tied to the boom itself. So who were the big picks and shovels players of 2025? Well, it all starts with Nvidia, of course. They make the GPUs, the literal brains of AI. But the ecosystem is huge. You've got companies like Vertiv providing the critical liquid cooling systems to stop these super powerful chips from, melting. Then there's Marvel, making the high-speed networking gear that's like the nervous system connecting everything. And you even have the established giants like Dell and HPE who package it all up into pre-built AI servers for big companies that just want a solution that works out of the box. And this just perfectly visualizes NVIDIA's complete transformation. I mean, look at this breakdown. The data center segment, which is almost all AI, grew to $51 billion in a single quarter. That's nearly 90% of the entire company's revenue. They really did become the ultimate shovel seller. And here's a perfect example of why being an essential supplier is so powerful. Think about it. Every single new AI data center needed advanced cooling. It wasn't optional, it was non-negotiable. And that is why a company like Vertiv, providing those critical systems, saw such incredible, resilient growth long before the peak frenzy even hit. Okay, so after all the dust settled on the madness of 2025, what are the core lessons here? How can we use this knowledge going forward? Well, we've boiled it all down into a 4-step framework for figuring out what comes next. All right, first up, look past the hype. You have to focus on real-world stuff like profit margins and verified contracts, not just flashy headlines. Second, understand the entire technology stack. Spreading your bets across chips, cooling, power, and networking helps manage the risk of going all in on just one thing. Third, timing is everything. The early days of a build-out can offer huge gains, but the risk and the volatility just ramp up as the market gets more crowded. And fourth, the big one, embrace the shovel strategy. Those essential, can't live without them suppliers often provide a much smoother, more resilient ride. But here's the kicker. The story doesn't end in 2025, not by a long shot. The amount of money planned for 2026 is actually set to be even larger. But the game itself is changing. New bottlenecks and new challenges are creating a whole new world of opportunities. And that brings us to the most important question for the year ahead. Now that this initial foundation is laid, what new problems need solving? What technologies are going to define the next phase of this AI revolution? We're seeing 4 huge frontiers emerge. First, the power problem. Seriously, these data centers are so energy hungry that tech giants are now exploring nuclear power. Second is the shift from training AI models to actually running them for users, a process called Inference, and that's opening the door for new specialized chips. Third, radical new chip designs are popping up that challenge the old way of doing things. And finally, as these server clusters get unimaginably huge, the networking that ties them all together becomes the new critical bottleneck and a massive, massive opportunity. At the end of the day, the great frenzy of 2025 taught us a really powerful lesson. The next wave of the AI gold rush is already here, and it's being driven by even bigger investments and brand new technological hurdles. And so it leaves all of us with one final question to think about. Are you going to be out there digging for the gold, or are you going to be the ones selling the shovels? 2025 was an absolutely wild ride for anyone investing in AI. Fortunes were made, and yeah, fortunes were lost. But what if I told you that all that chaos, all that volatility, actually left behind a clear blueprint for success in 2026? All right, so before we can even think about 2026, we have to look back. We have to understand the tidal wave of cash that just crashed over the tech world in 2025. And honestly, the numbers are so big, they're almost hard to wrap your head around. I mean, look at this. We are talking about a truly mind-boggling amount of money. Morgan Stanley figured that big tech poured over $400 billion into AI just last year. That's not just a small shift in strategy. That's a complete rewiring of where the money is going. It's an all-in bet. And this cash wasn't just sitting in a bank account. No way. It was fueling a global construction frenzy. S&P Global tracked a record $61 billion in data center deals alone. Companies were just racing to build these massive, power-hungry server farms that are the engine of the entire AI revolution. So who was writing these checks? Well, it was the usual suspects, right? The trillion-dollar tech giants, what we call the Magnificent Seven, with their super deep pockets and just an insatiable need for more data and more computing power. They were both driving the AI boom and, frankly, bankrolling the whole operation.
Okay, so with all that money being thrown around, you think everybody came out a winner, right? Well, not so fast. The reality on the ground was way more complicated and honestly a lot more volatile. And it's in that volatility that we find our first crucial lessons for 2026. If you really want to understand the wild ride that was 2025, you only need to look at one company, CoreWeave. Think of them as a specialized AI cloud provider. They're the ones renting out the super high-powered GPUs that other companies need to train their AI models. And their journey after going public, it perfectly captures the incredible highs and, well, the terrifying lows of this AI gold rush. It was a roller coaster, and that's putting it mildly. CoreWeave goes public in March at $40 a share. By the middle of the year, just fueled by pure, unfiltered hype, it had exploded to nearly $187. But then, reality set in, and by December, it came crashing back down to earth, landing somewhere in the $67 range. Just look at that number, a 367% gain. If you got in on that IPO, you nearly quadrupled your money in just a few months. That's the kind of explosive growth that gets everyone's attention, right? It's what fuels that massive fear of missing out. But you know the saying, what goes up must come down. And in the back half of the year, CoreWeave came down hard. People started getting worried about their debt, about new competitors jumping in, and just a general market cool down. It all sent the stock plummeting, wiping out over 60% of its peak value, and yeah, leaving a lot of people who bought at the top holding the bag. And this is where things get really, really interesting. Because while CoreWeave was on this insane ride, its main supplier, the chip giant Nvidia, was having a much steadier, calmer year. But another key player, the server builder Supermicro, was getting squeezed from every direction. It's a perfect lesson that a rising tide does not lift all boats equally. Not at all. And you know, it wasn't just the smaller companies that were all over the map. Even the big guys, the Magnificent Seven, had a surprisingly mixed year. So, why did some do great while others struggled? Well, it pretty much boiled down to two things. How much they depended on China for manufacturing, which really hit companies like Apple when tariffs kicked in, and, maybe more importantly, how convincing their AI story was to Wall Street. Alphabet, for example, had a clear vision and investors loved it. So, what is the big lesson here? What's the major takeaway from all this chaos and volatility? It's a lesson that's as old as investing itself, and trust me, it holds true for every single new technology that comes along. You probably heard this before. During a gold rush, sell shovels. And in the age of AI, the shovels are the chips. They're the cooling systems. They're the networking gear. They're the power plants. It is often a much safer and frankly more profitable bet to invest in the essential tools that everyone needs rather than trying to guess which one company is going to strike it rich. And a perfect real-world example of a modern-day shovel seller is a company you might not have even heard of, called Vertiv. They're not making the flashy AI models that are on the news. No, they're providing something arguably just as important, the critical air conditioning and electrical infrastructure that keeps the whole operation from, well, literally going up in smoke. And just check out these numbers. While the rest of the market was panicking, Vertiv was just quietly crushing it. Sales were up big, but the really incredible number here is that 60% jump in new orders. That is a direct signal from customers saying, we need more of your stuff, and we need it now. Demand is accelerating, not slowing down. So what is it they actually make? Well, they make these super high-tech cooling systems that stop the new generation of AI chips from overheating. See, these chips, they're the brains of the AI revolution, but because they're doing trillions of calculations every second, they get incredibly hot. Without companies like Vertiv, the entire AI industry would literally grind to a halt. And it's not just cooling systems. The picks and shovels of this AI gold rush make up a whole ecosystem. You've got the obvious stuff, right? The GPUs from Nvidia and AMD. But you've also got the less glamorous but equally essential things like the networking gear from Marvell, the companies like Dell that actually put all the pieces together, and yeah, even the energy providers that keep the lights on. And that brings us to what might be the single biggest bottleneck of all: power. I mean, these AI data centers are like giant, energy-sucking vampires. The demand for electricity is so massive, so intense, that tech companies are now going straight to the source. They're cutting deals directly with nuclear power plants just to get the constant, reliable energy they absolutely need. Okay, so we've seen what went right,
We've definitely seen what went wrong in 2025. Now it's time to put it all together. We are going to take every one of these lessons and build a simple, practical framework that you can actually use to make smarter AI investments in 2026. Look, when you boil it all down, there are really just 4 simple rules for investing in AI this year. Number 1, get in on the infrastructure build-out. Number 2, ignore the hype and follow the real money. Look at actual orders and contracts. Number 3, don't put all your eggs in one basket. Diversify. And rule number 4, maybe the most important, be patient and wait for a good opportunity to buy. And that last rule is so important. When the market gets nervous and everybody starts selling, that's your moment. That's when you can find some amazing deals on truly great companies. The trick is just having the courage to buy when everyone else is panicking. Here's a perfect example. This is a list of 4 companies that a sophisticated computer model over at Seeking Alpha flagged as strong buys late last year. Now, this kind of quant model doesn't have emotions. It just crunches numbers on things like value, growth, and profitability. And the key thing here, all of them had recently sold off, which means you could have potentially gotten in at a discount. So to recap, here's our game plan for 2026. On the opportunity side, we're looking for those essential picks and shovels companies. We're waiting for them to go on sale, and we're not afraid to invest in the big, diversified giants. On the other side, the red flags. We are avoiding companies whose profits are getting squeezed, we're staying away from stocks that are priced for absolute perfection, and we're always keeping an eye on geopolitical risks, like tariffs.
Okay, so we've talked a ton about data centers and stock charts and valuations, but what does all of this actually mean in the real world? Why should you care about any of this? Because at the end of the day, the only thing that matters is how this incredible technology is actually changing our daily lives. All those billions and billions of dollars in infrastructure, they're being spent for one reason: to make our lives easier, better, more convenient. And there is no better example of that right now than what's happening at your local Walmart. Just last year, Walmart rolled out a whole suite of new AI tools designed to make shopping less of a chore. You need to find the ketchup? The app will guide you right to the exact spot on the shelf. Planning a Super Bowl party? Their AI assistant, Sparky, will help you build a whole shopping list. It is all about using that massive data center power to save you time and hassle.
And look, this isn't just about making customers happy. It's about making money. It's just smart business. Walmart knows that when you use their app in the store, you spend more. A lot more, like 25% more. So by making the app better and more useful with AI, they're not just helping you find stuff, they are directly helping their bottom line. And this is a trend that is only going to get bigger and bigger. As you can see on this chart, younger generations, millennials and Gen Z, are already super comfortable using AI to help them shop. As they become the main consumer force in the economy, that comfort level is just going to become the new normal. For companies like Walmart, this is a massive tailwind pushing them forward. So what does it all mean? We've looked at the money, we've looked at the stocks, we've even looked at the shopping carts. But what does it all add up to? What is the next big thing in this AI revolution? Think about it this way. We have spent the last few years building the roads and the railways of the new AI economy. It's been all about the infrastructure. Now, the big question is, what are we going to build on top of it? What are the killer apps, the revolutionary services that are really going to change the world? That, right there, is the next frontier. And that's where the real fortunes are going to be made. So, if you were watching the markets at all in 2025, you know it was an absolute frenzy around artificial intelligence. I mean, fortunes were made, the volatility was completely off the charts, and everybody everywhere was talking about the next big AI model. But here's the thing, the real foundational story isn't just about the software. It's about this massive global construction project that's happening right now, and the numbers behind it are just staggering. Okay, let's set the scene. The year 2025 was completely dominated by the Magnificent Seven. It was a really high-stakes game where every single earnings call, every capital expenditure plan was being picked apart for clues about what was coming next. And okay, so to make this feel real, let's zoom in on one company that just perfectly captures this moment, CoreWeave. Think of them as a specialized AI cloud provider, heavily backed by Nvidia, who basically rent out supercomputing power to others. Their journey in 2025 is the perfect example of this entire infrastructure boom, the incredible highs, and the very harsh, very physical reality. And this timeline just shows you the insane volatility. In March, they IPO at $40 a share. By the middle of the year, the stock explodes to $187. That's a 367% gain. The hype is totally real, their order book is overflowing. But then, reality hits. In November, they announce a delay at one of their new data centers. Because of a power issue, the stock just craters, falling over 63% from its peak. It's the classic story, right? The digital ambition of AI runs headfirst into a very physical, very real bottleneck.
And what's so interesting here is how this chart just perfectly visualizes the risk and the reward. I mean, that huge jump from 40 to 187, that's the market's pure optimism, the sheer unbelievable demand for AI compute. But that sharp drop down to 67, that's the market waking up and realizing, whoa, building this stuff is actually really hard. You're exposed to real-world problems, like just getting enough electricity to a building on time.
The CoreWeave story is just such a powerful example. But it's really just one piece of a much, much bigger puzzle. It's kind of like a window into this entire ecosystem of suppliers that we can think of as the AI factory. So using that story as our guide, let's zoom back out and map all the different layers of this industrial boom, from the tiny silicon chips all the way to the giant concrete buildings that house them.
We have to start at the top, with the chip barons. And in 2025, that meant one name, Nvidia. Their dominance was, well, it was staggering. In a single quarter, their revenue hit a record $57 billion. And get this, out of that, $51.2 billion came from their data center division alone. They are the ones supplying the GPUs that power this entire revolution, and their financial results just scream it from the rooftop.
But here's the twist. Just selling shovels wasn't a guarantee for success. This comparison is so important. On one side, you have server makers like Supermicro. Yeah, demand was high, but they were dealing with intense competition, inventory headaches, and serious pressure on their profit margins. But on the other side, you have a company like Vertiv. They make liquid cooling systems. Not as glamorous, right? But because these new AI chips run incredibly hot, advanced cooling isn't a luxury anymore. It is absolutely essential. So Vertiv saw crazy demand and multi-year gains of over 1,000%. It shows you that the more specialized and essential your shovel was, the safer you were from the market's mood swing. And finally, at the bottom of the stack, you've got the landlords, the companies that actually own the physical data centers. In 2025, we saw what some sources called a global construction frenzy. Mergers and acquisitions in the data center world hit a record $61 billion. And what's fascinating is how it was all being paid for. The big tech hyperscalers, your Amazons, Googles, Microsofts, they weren't just paying with cash. They were taking on huge amounts of debt to finance this expansion, which just raises the stakes even higher.
All right, so you've got the chips, you've got the servers, you've got the buildings, but all of these AI factories need one more thing, a colossal, almost mind-boggling amount of electricity. And this massive new demand for reliable 24/7 power has led to a really surprising comeback for a classic and, let's be honest, pretty controversial energy source. That's right, nuclear power is firmly back in the conversation. And why? Well, unlike solar or wind, nuclear provides constant, carbon-free baseload power. It's that 24/7 reliability that an AI data center absolutely has to have. And this is not just a theory. Microsoft is now buying power from Constellation Energy's nuclear fleet. Amazon took it a step further and bought a data center that's plugged directly into a nuclear plant. This huge shift is also creating a ton of interest in next-gen tech, like small modular reactors, which are basically compact, factory-built nuclear power plants. So, what does this massive, power-hungry industrial build-out actually mean for you? Well, whether you're an investor, a creator trying to build a business, or really just a consumer, this whole revolution is already having an impact. So let's break down some real, actionable takeaways for 2026. For investors, that picks and shovels strategy is still looking really compelling. The key is to look at every single layer of this infrastructure stack. For instance, Seeking Alpha's quant analysis flags a few strong buy-rated companies that have pulled back recently. Now, this isn't investment advice, obviously, but it just shows you the diversity of this whole ecosystem. You've got AMD supplying the core hardware, Applied Digital actually running the data centers, Fabrinet making essential optical parts for networking, and Johnson Controls providing those critical cooling systems. Now, for creators, all this massive investment means that powerful AI tools are cheaper and more accessible than ever, and that is creating some amazing new opportunities. One of the fastest-growing side hustles of 2025 was a direct result of this, selling simple AI-powered digital products. We're talking about things like pre-built Notion dashboards or libraries of really good prompts for ChatGPT. The business model is kind of genius. You use 3 AI tools to build the thing, you sell it on a marketplace like Gumroad that handles all the logistics, and you use social media to drive traffic.
And this just shows you the potential. This is not just a theory. Public data from marketplaces in late 2025 showed real people scaling these simple digital businesses to $3, $5, even $12,000 a month, and often in just 90 days. It's an amazing, low-cost, high-margin way to get in on the AI wave without having to be a coder.
And for everybody else, this huge infrastructure boom is already showing up in your day-to-day life. Just take Walmart. For the 2025 holiday season, they rolled out a whole suite of new AI tools. If you use their app, it can now give you turn-by-turn directions to the exact spot on the aisle for an item. Their virtual assistant, Sparky, can help you build an entire shopping list for a party. It's a perfect example of how all this back-end investment is already turning into a better, smoother experience for you.
So as we look ahead to 2026, this great AI build-out is only going to get faster. But the big question is starting to shift. See, we've spent hundreds of billions of dollars on training these massive AI models. The next chapter, the real test, is all about inference, the cost of actually running them to generate answers and create value in the real world. How will that massive training cost translate into profitable everyday apps? That right there is the story we'll all be watching in 2026.